Well, welcome everyone. I'm sorry, I was just letting you know we've got everyone on mute just for a little bit of crowd control. But what we'll be doing today is having a conversation really with GMO, who is our partner within our quality equity strategy in our portfolio. I'll get into that more in just a minute, but just some housekeeping items. We are recording this call, and we will have the link available for everyone if they would like it, or for anyone who missed it once the call has gone through compliance. So thank you all for bearing with us. The other thing I'll let you know is at the end of today's call, towards the end, we'll have a Q&A session. And the way you can ask a question is actually through the chat at the bottom of your Zoom screen. Your questions will go to us here at Acumen, and we will get your questions to our GMO partners, Kim Mayer and Benjamin McCormick. But first, I just wanted to welcome everybody. We're excited to have our partners GMO on the phone with us. We'll do some introductions of them in just a second, but first, I just wanted to offer a little bit of context. Within our portfolio, Acumen is striving always to use a quality first approach, whether we're talking about stocks or bonds or other types of investment vehicles. We really feel that is important to the long-term portfolio performance for our clients. And we really believe that is the best way to absorb different market cycles, different economic conditions, is just through having that quality first lens in the bulk of the portfolio. The biggest component of that for us is in our core equity portfolio, and that is where we partner with GMO. They are a 40 years of experience and a large global team behind them, and they really help us. We're able to leverage them, and we're able to leverage Acumen's scale in order to get high quality companies into our client portfolios. So we're very excited to have them on. Ben, I will turn things over to you just to get the introductions done, and we're excited that you're here. Thank you.
Great. Thanks, Ashley, and thanks to the Acumen team for inviting us in to speak today. Can everyone see the slides I've pulled up?
Yep.
Yes.
Great. So again, happy to be with you all today. My name is Ben McCormick. I'm a member of GMO's Global Client Relations team. I've been with the firm about 14 years now, and I'm joined by Kim Mayer, who is a senior member of the focused equity team that manages the quality portfolio. So really appreciate the time. I figured I'd give just a quick 2-minute overview of who GMO is as a firm, and then we can sort of pivot into the quality strategy with Kim. GMO is a privately held investment management firm. As Ashley noted, we've been around for actually close to 50 years now, founded in 1977, privately held partnership, owned and operated by 48 employees of the firm. And you'll note on the slide here, we reference long-term valuation-based investing. That's a pretty important piece of what we do and really flows through all of our investment strategies, including the flagship quality equity strategy. We are based in Boston. That's where Kim and I are sitting today, even though we're in separate offices. I swear we're not that antisocial. Kim and I will probably be having lunch afterwards. Based in Boston, but we've got satellite offices across the globe, namely on the West Coast, pretty big hub in London, Amsterdam, Singapore, and Sydney. We run about $65 billion in assets across equities, fixed income, alternatives, and multi-asset. There's 10 discrete investment teams here at the firm. Focused equity is one of those teams. Each team operates pretty autonomously here, but benefits from sort of shared resources across trading, IT, operations, client relations, my role. So we've really got quite a bit of firepower that the team can draw from. This slide just gives a very brief overview of the broad offerings here at the firm. I would direct your attention specifically to the green area under equities and then a line below that where it says focused equities. So that's what we're focused on today. That's the team that manages the flagship quality strategy that we've been running here as a dedicated offering since 2004, although as Kim will likely allude to later on, quality is something we've been thinking about and incorporating into our investment strategies well before the launch in 2004 as a standalone. We run about $28 billion in assets across quality today. That includes very large institutions across the globe and also select private wealth partners such as Acumen. So that's kind of my quick 2-minute rundown of the firm. Why don't I hand it over to Kim to get into quality more specifically?
Awesome. Thanks, Ben. And thanks to all of you for tuning in this morning. Ben, I think you probably have the hardest job here because, as you know, I'm not always the most linear speaker. I don't always exactly follow the order of the slides, but I will do my best. And we'll sort of divide this discussion into 2 or 3 main topics. The first one will be sort of how does GMO think about quality investing? We are very much aligned with Acumen in the belief in the quality style of investing across different asset classes, certainly within equities. And as Ben already alluded to, we have a long history of investing in quality equities at GMO. We have had the dedicated strategy for 20 plus years, but you can actually trace the origins of that quality process within our overall equity investing portfolios actually back to the earliest days. So we'll talk a little bit about what we mean by quality at GMO. Certainly, quality is a very well-used buzzword these days. And so we'll try to give you a little bit of a flavor for the differentiated approach that we bring to quality investing in equities. Then we'll follow that with what does the resultant portfolio look like? And how do we construct the portfolio? What have been the major areas of exposure over time? And then follow that with what about the performance? What does the performance pattern look like? What should you expect going forward? And since we are operating these days in a very exciting investment environment, we'll leave some time for questions toward the end. I hope there are some questions about the sky's the limit. Current events, how do you invest in quality in sort of as disruptive an environment as we are operating in right now? So let's start with why quality. So, I think we would tell you at GMO that quality is a really, really good place to start. The quality style of investing has done better than broad markets over time, and it's done so while exposing investors in quality to lower risk. So we think it's a really, really good place to start, but we don't think it's sufficient. And we'll get into that a little bit more as we talk a bit more about our process in a little bit more detail. I think there are 3 major areas of differentiation that GMO quality brings to the table. And those are nicely illustrated here on the slide that Ben has up. So the first of those is we have a whole lot of experience in investing in quality at GMO. We've been managing the strategy for 20 years, but you can trace the origins again back to the earliest days. And what I mean by that was when Jeremy Grantham, who's one of our founders, was in the process of putting GMO together. One of the really interesting issues that he was grappling with was that he had identified this group of companies. They were quality companies. They weren't even called quality companies, though, nearly 50 years ago, but that's what they were. There were these companies that could generate strong returns across periods, tended to do particularly well during periods of volatility, had rock solid fundamentals. That's a pretty good idea of what a quality company is. But the reason that was sort of a challenge for him was because way back then, he certainly would have described himself as a classic value manager. And one of the things, another attribute of quality companies is that they tend to trade at a pretty significant premium to the rest of the market. And therefore, we're out of reach for a classic value manager like Jeremy. He went off, did some research, and what that research generated was what you could very well argue was one of the first quality factor models that anybody had ever come up with. What Jeremy's research showed him nearly 50 years ago was that companies, business models that have a long track record of generating high return on capital, have stable return on capital, and have clean balance sheets, those are the companies, those are the business models that are most likely to persist in generating that high return on capital going forward. That's a pretty good quantitative definition of quality. So the way GMO initially used his insights was just to build those into our valuation models. So to a very large degree, that valuation practice that GMO has been known for throughout the years has never been simple value, but has always been this notion of quality adjusted value. In other words, it enables you to figure out what premium it's worth paying for a really high quality business model, and conversely, what discount you should demand for a very junky business model. So for the first 25 years or so of our history, that's the way we used our quality insights and our investment practices at GMO. Flash forward to the early 2000s, and we're looking at the opportunity set within equities at the group level. And there's not a whole lot interesting going on. In other words, large versus smalls, not that informational, growth versus values, not telling you a whole lot. But this quality group did look interesting versus its long-term history. In other words, it wasn't trading at nearly that same premium that it had historically. And that's what motivated us to launch the strategy aimed directly at the quality group when we did in 2004. And when we launched the strategy, we made another important decision, which was to not abandon that focus on valuation. So in other words, rather than just launch the best quality factor portfolio that we could, we made the decision to launch a value adjusted quality portfolio. So that valuation focus is something that we've always done. And the reason behind that is because our data showed us then, our research continues to show us now, that you can do better than a quality factor portfolio by focusing on valuation. You can increase those returns across periods. You can pretty significantly increase that downside protection signature as well by combining value and quality. That's an important differentiator. And it's meant that over the 20 years that we've been managing the strategy, but it shows up very loud and clear over the last several years. It's resulted in a differentiated return pattern. We'll see that a little bit later in the discussion as well. And finally, the last differentiator is a simple one. There's plenty of purely fundamental managers out there that can deliver quality portfolios. There's any number of quality factor, more systematic quality factor portfolios. As we have delivered this portfolio over the 20 years, we've always combined what we believe to be the best of both worlds. We use quantitative investment techniques. That shouldn't be surprising if you know anything about GMO. Also have a very heavy dose of fundamental input in our process as well at each step of the process, which we think is the only way that you can deliver the very best quality portfolio today. So let's jump forward a couple of slides now to slide number 8. Which is just to look at our process. So this is sort of like a 5-step process. I'm going to boil it down to 2, maybe 2.5 steps to describe our process today. So we start with an investment universe with flagship quality. It is a relatively unconstrained global investment universe that we're looking at. The constraint that we do put on there is one of size. So we're really just looking at companies that are 5 billion in market cap and above. That gets us from 8,000 or 9,000 securities to a couple of thousand securities right off the bat. Job one is we're going to build the very best quality universe that we can. Job number 2 is we're going to use valuation primarily to select stocks within that universe. And then the last kind of half step in our process simply recognizes that there's certain risks that we're going to be exposed to at the portfolio level that neither quality nor value give you a whole lot of insight into. So that's simple stuff like diversification risk or liquidity risk, but we also think a lot about the policy risks, the sort of the more thematic risks that we're underwriting at the portfolio level as well. And we may, as a result of observations of those more fundamental risks, tweak some of those model portfolio weights. So let's start with job number 1, building that quality universe. We're going to combine quantitative and fundamental inputs. The very first step in job number one is we run a quantitative screen that we use primarily as a sorting tool that is based on those same, our quant model is based on those same three identifying factors that Jeremy came up with all those years ago. Our quant model also seeks a long history of a company being able to generate high return on capital, stable return on capital, clean balance sheet, with the intuition, again, that those companies are the most likely to be able to continue to generate that high return on capital going forward. I would tell you that our quant model is really, really good. I would tell you it's one of the best out there. I'd probably tell you it's the best out there, but it's not that different from a lot of other quantitative quality assessment tools. They're all going to be oriented around pretty similar factors. Number two, I would also tell you that the very best quant models are imperfect. In other words, they're occasionally going to generate false positives. They'll occasionally spit out some false negatives. And I would also say that you just can't have enough conviction in a purely quantitative, more backward-looking quant model in that quality assessment. So in our process, the way that we seek to solve for those imperfections is we spend a lot of time fundamentally vetting the output of that quant model with three goals in mind. Number one, let's eliminate those few false positives. Number two, let's add back in those few false negatives. And number three, let's just increase our overall conviction around that quality score. And as we're doing that fundamental analysis, we also sort of orient around three pillars. Just as our quant model orients around three pillars, so does our fundamental analysis. Number one, we want to understand, what is it about a particular business model that enabled that business model to build this economic moat around its business? What led to that competitive advantage? It's all well and good that they were able to do that historically, but we need that confidence that they're going to be able to continue to do that into the future. In a similar vein, we want to make sure that the business models that we're investing in didn't just take advantage of some historical niche that's eroded over time. In other words, that some new threats have not arisen on the horizon. And finally, and perhaps most importantly, we spend a lot of time thinking about that idea of capital allocation prudence. Because one of the great things about quality companies is they throw off a whole ton of cash. So there's a lot of capital for management to play with, which is a great thing, but you need to make sure that management is going to be prudent with that responsibility. Because one of the easiest ways to sort of, from a self-inflicted standpoint, to change a business model from a high quality one to a low quality one is to make some massive misallocation of cash. So when we're speaking with management as part of our fundamental research process, most of that interrogation revolves around that idea of capital allocation prudence. So at the end of that process, we're now about halfway down slide number 8 here, we have a vetted universe of about 100 securities or so. And now it's time to start job number 2, doing that valuation work to select the more attractively valued stocks within that universe. We're going to triangulate around valuation as well. We've got very good quantitative valuation models that we've developed over the years at GMO, but we do lean most heavily on a more fundamental view around valuation, a DCF model that we've also tweaked over the years to be as useful as it can be for this particular quality universe. So at the end of that process, we now have at the end of that step, we now have the valuation sort within that quality universe. Now we have the 2 pieces of information that we need to build those model portfolio weights. And it's a super simple heuristic that we follow there. Your maximum position size is determined by how high quality you are. And then we simply use valuation as a dial to determine how full versus maximum position size you're going to get filled. And that dial does go from 0 for companies that may be very, very high quality, but are just trading today with too much valuation risk. They're not going to make it into the portfolio. And it goes up to 100% for those companies that are attractively valued. And top tier quality companies can have a maximum position size of 6%, mid-tier 3% at time of purchase, bottom tier at 0. So you sort of follow that logic through, and the way you get to be a 6% position at time of purchase is your top tier quality and you're attractively valued. Then it cascades down from there. And then the last step in our process simply recognizes that there's, again, we may be exposed to risks that quality and value don't give you much insight into. So liquidity risk, diversification risk. When we think about diversification, we're not just thinking about sector diversification. We're also thinking about balancing that business model risk that we're exposed to. And also thinking a lot about end revenues that we're exposed to by our different, that our different companies' revenues are serving. But then also policy risk. I guess it goes without saying that we pay a lot of attention to geopolitical risk these days. How much end revenue exposure, for instance, do we have into China? How much supply chain exposure do we have across China? Do we feel comfortable at the aggregate portfolio level with that risk? Thinking about how much for instance, risk of antitrust regulation are we underwriting at any moment in time? And we may tweak some of those model portfolio weights as a result of those real world observations. And we end up with a final portfolio that on average is about 40 securities. It's designed to be a high conviction portfolio, only owning high quality businesses, but more so only owning those high quality businesses that are not trading with too much valuation risk today. Importantly, it is constructed in a benchmark agnostic fashion. In other words, it's designed to beat the S&P 500, but we feel the best way to beat the S&P 500 is essentially to ignore the S&P 500 from a risk management standpoint. Ben, here's where I'm going to skip around a little bit. We're going to jump first to slide number 11, just to look at the key exposures in the portfolio, and we'll come back in a moment to look at sort of the performance patterns that result from this. And so you see this bar chart here that has a bunch of different colored slices in it. So that's just to illustrate that while this is a focused portfolio, it's not a portfolio that's unduly concentrated in any particular business model. So good diversification from that standpoint. But we also think about diversification across these three key categories of exposure that we have. In other words, the three key categories of quality business models that we underwrite through time. And you can see those called out on the left-hand side of slide number 11. Core quality, quality value, and quality growth. These are terms that we've come up with ourselves, but I think you'll see that they make a lot of sense. Core quality, you can think of that as sort of the most old-fashioned, your grandparents' version of quality. Those are going to be the most defensive, the very most resilient business models. So consumer staples, Nestle, Mondelez, et cetera. Those consumer staples companies. Within healthcare, it's going to be big pharma, so J&J, Roche, Eli Lilly, but also big med device companies. On average, that's something like 25 to 30% of the portfolio. Quality value begins to bring in a bit more economic sensitivity, perhaps a bit of cyclicality. So within healthcare, that's going to be managed care companies that always trade with a slight overhang on their valuations due to the policy risk. Industrial cyclicals, travel and luxury, so Safran, LVMH, the small number of financials and payments that meet our quality criteria. For instance, Visa fits squarely into quality value as well. On average, that's also about 25 to 30% of the portfolio. And then the remaining 45% or so fits into quality growth. That's going to be obviously the growthiest business models that we own. Mostly tech, but not just tech. We also include a small sliver of healthcare there. For instance, Intuitive Surgical fits into quality growth thanks to the very strong secular growth tailwinds attached to their dominant position in surgical robotics. Within tech, it's mostly software and services, internet, semiconductors. We call out Apple just because it's kind of a unique business model. Important to note that we don't have a top-down view sort of dictating how large each of those three exposures should be. That really is just a fallout of our bottom-up analysis of valuation and quality, but it's also pretty stable across time because we are rebalancing within the overall opportunity set based on valuation. And although those valuation assessments are made stock by stock, there tends to be kind of this observable direction of travel attached to that because most growth business models tend to move together, et cetera. And so because we have through time exposure across quality growth, quality value, core quality, it means that we're not dependent on a value regime being in place or a growth regime being in place in order to be able to deliver strong returns. It means that our return pattern does tend to be more core-like, certainly more core-like than most other quality managers that are going to have this very persistent tilt towards growth. And that is illustrated very nicely in slide 12. I mentioned earlier that this has sort of shown up very loud and clear, our differentiated return pattern over the last several years. And we attempt to illustrate this in this particular slide. And so we're looking at two different time periods. 2022, that was the year, remember, when growth had its reckoning. And then the 2 years that have followed 2022, when growth, it's sort of been back to the races for growth. And we see in 2022, what we're looking at here is just the relative returns of those three key exposures within our portfolio versus the S&P 500. So in 2022, it was core quality, it was quality value that were nicely beating the S&P 500, while growth within quality was losing by about the same amount. You do that 60-40 math, we were able to beat the S&P 500 in a year when most other quality managers were not, because in retrospect, most other quality managers ended up being overly exposed to growth within quality. We still had that exposure, but we had been trimming the prior 2 years, especially around those edges where quality growth had become particularly expensive. And then by mid-2022, as growth was getting derated, we started to find some interesting valuation opportunities opening back up within some of those same names we'd spent the prior 2 years trimming. We began to reallocate capital back in that direction, trimming from some of those more defensive names that had worked so well in the first 6 months of the year. And that in turn set us up very nicely for what 2023 and 2024 have looked like. Actually, this is updated through the first month of 2025, when it's been, off to the races again for growth. And during that aggregate period, we've been able to nicely beat the benchmarks as well. So once again, a more core-like return pattern and not dependent on one versus the other being in place in order to generate strong returns. If we jump back a slide to slide 10, we can see that sort of performance pattern over a longer time period. And so on the left-hand side, we can see just plotting return versus risk. So this is plotting just our average annual return for the 20 years that we've been managing the strategy against average annual volatility as a pretty decent proxy for risk. And so during that 20-year period, on average, we've beaten the S&P. We've beaten 3 of the 4 indices that we show here, and versus all 4 of them, we've delivered pretty significantly less risk. So think about the risk-adjusted return, the flight path of those returns. I think this nicely illustrates another reason why we are so often hired for core equity exposure, low risk core equity exposure. And then how we win on average over time is illustrated on the right-hand side. So during your average up months, as we illustrate in the bar charts on the upper right-hand side, we do a good job of keeping in touch. We don't quite keep up, but we keep in touch during your average up month. We do a very good job during your average down month of protecting capital. And then every once in a while, the market is behaving in an anything but average way. Periodically, volatility hits the fan, and we illustrate our performance pattern during those episodes in the table on the lower right-hand side. And keep in mind, these are real. These aren't back tests because we have been doing this for 20 years. And so during those episodes, we do a very, very good job of protecting capital on the downside. You put those ingredients together, and this turns out to be a very prudent way of gaining core equity exposure over a long period of time. If we dial a little bit more into the details of what we own, and I'll wrap these comments up to leave time for Q&A in a moment. Slide 13 shows you the overall portfolio. This snapshot was taken as of the end of December. Very little change since then. We've only added a couple of new names so far in 2025. But this is organized to show you, number one, where, what areas of the market we tend to find high quality businesses. So technology, healthcare oriented, consumer oriented, and then a small handful of more miscellaneous business models. But we also show the vintage of the years that, how long have we owned these particular companies? And the largest group is in that top row, which is more than 10 years. It is a low turnover portfolio. On average, we deliver about 20% turnover per year. That's total dollar turnover. Name turnover is pretty significantly less than that, but it's not a static turnover. It's not a static portfolio. You can see we have, over the course of the last couple of years, added 6 names or so, and different vintages throughout there. Another question that we're getting a lot these days is, what about how are you operating in these very, very concentrated markets? How are you guys performing? How do you handle thinking about what exposures you should have, for instance, versus the Mag 7? And so here's a chart that's showing that. So, over the course of the last 10 years or so, we have had pretty decent exposure to the Mag 7 stocks. I should point out that we own 5 of the 7. The 2 that we don't own are Tesla, which in our opinion is not a high quality business model. And the second one we don't own is NVIDIA, which is, in our opinion, a very high quality business model, but one that we do feel has too much valuation risk. And so you can see we've had pretty steady weight for the last 8 or 9 years, roughly comprising about 20% of the portfolio. But that positioning has, gravitated from being a pretty decent overweight to the S&P 500 in the years preceding 2020 to being a pretty decent underweight. We don't think in terms of our relative position sizing, but it does sort of illustrate that point nicely. Another question that we get pretty often, and just because this is nominally a global portfolio, is how do we think about areas of exposure? And slide 15 I think is just a good way of illustrating that. On average, in terms of areas of domicile, in round numbers, a little bit more than 20% of our portfolio tends to be in weight space, in companies, invested in companies that are domiciled outside of the US. So that means that we're a little bit more, we have a little bit more non-US exposure than some, purely domestically oriented managers. But from a fundamental standpoint, this is quite a global portfolio, is now, always has been. So if you track sort of where the revenues are coming from, you can, in those 3 circles on the top of slide number 15, you can see, in round numbers, a little bit more than 50% of our revenues are into the US. That's a bit more than the S&P 500, but the S&P 500 is in itself, comprised of a lot of large global companies as well. I am going to pause there now to see where else folks would like to focus. I guess the last thing I would do before I turn our attention, open it up, is to, and these are going to be some very small numbers here, but this is the way we have to show this for GIPS compliant reasons in this type of portfolio, this type of presentation. But slide 18 does show you our, sort of our annual returns and our 1, 3, 5, and 10-year returns versus the S&P 500. So once again, illustrating, sort of no matter what period of time you're looking at, a very good way of getting core equity exposure in a low risk fashion while generating some strong returns.
Kim, thank you. I'll just remind everyone, if you have a question, to put it in your chat, and that'll come directly to Luke and I here at the desk. And it is right at the bottom of your screen. So we'll maybe give folks a moment to put that in, Kim. But I think one of the things that we've talked a lot about, obviously, over the past few months is just sort of the increased policy risk. And I think we're clearly seeing the headlines come out around tariffs on a daily basis. With a lot of volatility forming around that. Can you share kind of what those conversations are like around the GMO quality table? And are there any tweaks that you're considering or have made as a result of some of those tariff conversations?
Yeah, it's a great question. And so you can think about sort of tariffs specifically. You can think about sort of almost an anti-globalization trend more generally, perhaps a sort of a deregulatory environment. Certainly you know, when we think about the drivers of performance during the fourth quarter, and to a certain extent, the year so far, those have been the primary drivers of performance. And as we think about tariffs and specifically in that context, sometimes it's not day to day, sometimes it's intraday, right? 4 or 5 Mondays ago, we had tariffs on in the morning and then tariffs off by the end of the afternoon. And so it is almost moment to moment. And this is a portfolio comprised again of global companies that are to a certain degree in the crosshairs of potential and real tariff action. When we look at into our portfolio performance on a day, when the market is most focused on tariffs, we tend to outperform a little bit. I think that's due to two primary reasons. Number one, we are always going to have that defensive ballast, that weight in those consumer staples companies, those healthcare companies that are going to be the most defensive. Number two, our portfolio is more tilted towards companies that are providing services rather than goods. But we do own companies that are clearly in the crosshairs. The best example of that would be Constellation Brands, where the asset that we really like within Constellation Brands is, guess what? Their imported beer business from Mexico. So clearly subject to tariffs, 25% tariffs on Mexico. And so in those cases, we do scenario analysis. We can run the numbers in terms of what is the impact on their actual profitability if tariffs of 25% come in at a certain point on their overall cost of goods, and we can do that scenario analysis. We're going to haircut our growth patterns, our margin assumptions based on that. And given where Constellation Brands is trading today at pretty significantly lower multiples than they have historically, we continue to think that that's a good bet to make. And by and large, one thing that we don't do in managing this portfolio is sort of make forecasts in terms of where policy is headed from here. What we're more likely to do is look at, okay, where does the market have a whole lot of conviction right now? Do we believe that conviction is more strong than it should be? And if we do believe that conviction, one way or the other, is stronger than it should be, we're going to lean into that and add to those positions that may be trading on 100% expectation that tariffs are going to be in place now and forever. So, for instance, that's why we did add to a bit of weight to Constellation Brands late in the fourth quarter.
Thanks for that. We've hit on Mag 7, we've hit on tariffs, and I guess the third hot topic is AI in general.
Yeah.
So I guess number one, I think it'd be nice to know for our clients, we get a lot of questions about this. How are you implementing AI as far as your processes go? And then also, you just touched on where's the market convicted. A big part of that has been the semiconductor names, the hardware names that are going into that.
Yeah.
I'd like to hear your thoughts, even this morning, hearing that you have new AI models from Chinese-based companies that are kind of bringing that thesis into question, maybe what the team is thinking about that going forward.
Yeah, so great question. So, several things going on sort of embedded in those questions. So in terms of sort of implementation of AI into our investment process, something that we continue to bring into our process to a larger degree. There's interesting things that you can do in terms of the fundamental research, just helping you sort of comb through large reams of written data. That's primarily the way we're implementing it so far. In terms of how we think about AI as an overall investment thesis, I would tell you that at a high level, philosophically, we are believers on the Focus Equity team in the transformative potential of AI to our everyday lives as humans, to our work lives, at the enterprise level, et cetera. And where it becomes trickier and trickier is, thinking about the real economic impacts on individual business models. And so what we, another sort of firmly held tenet that we operate under across the board is we never like to bet on too specific an outcome. And so, one way that you can bet on too specific an outcome right now, potentially too specific an outcome, is to own NVIDIA. You've heard that we don't own NVIDIA. And we would tell you that there's just too much optimism baked into those expectations around the long-term growth potential, the long-term ability for NVIDIA to keep margins at current levels. Now that's beginning to come out of that price. As we've seen, it's down, I don't know, something like 30% from its peak. Part of that is due to these news stories that are coming out of China, DeepSeek today, et cetera, which do call into question to a certain degree the levels of capital expenditures that may be necessary going forward to maintain, your position in the overall AI, call it arms race. So we do have AI exposure in this portfolio, though, but rather than getting it in this pure play vehicle that you could say NVIDIA represents, we have it more in these embedded options across a number of other high quality tech companies that are certainly investing large sums of money in their AI aspirations. So we own those types of business models. We also own other supply chain, other picks and shovels players alongside NVIDIA. So we own, for instance, Lam Research, KLA, those semi-cap equipment manufacturers. We own TSMC, the foundry for every single GPU chip that NVIDIA designs. And then downstream from those, we own the Microsofts, the Metas, the Alphabets, those companies that are investing billions and billions of dollars per year. It's highly likely, more likely than not, that some of that investment is going to turn out to be misallocated. The management themselves have said, they'd rather risk, being too early, paying too much than being too late. But the good news is when we think about, if Microsoft or Meta turns out to be, misallocating some of that capital, it's still a pretty small percentage of their overall revenues, a pretty small percentage of their overall market cap, A, and B, there's going to be a high degree of fungibility in terms of what it is that they're buying around data, data centers, around, GPUs, et cetera, more generally. And if that doesn't turn out to be, utilized quite as quickly at quite the same level of monetization, there's a very good chance that ultimately it will be. So it's, very good chance that these companies will themselves survive and thrive. And so we have been playing AI in a more diversified fashion with, in our opinion, lower valuation risk. And that's one of the reasons we've been able to keep up, with broad markets, across the last few years, while not owning a single share of NVIDIA, because we have been nicely exposed to the theme, just in a different fashion.
That's great. No, and great questions. We did get a couple in the chat, and Kim, maybe you can speak a little bit to some of the different packages that the quality strategy comes in. So there's the individual stock package, and then for some of our clients, they're in the ETF. Maybe you could talk a little bit about the differences there and anything that you'd like to note, either performance-wise or expectations-wise, around the differences between those two.
Yeah, and so, one of the things that we've spent a whole lot of time doing over the course of the last, 5 or 10 years is to make this quality strategy more widely available in various formats. 10 years ago, the only way you could get the quality strategy was by investing $10 million in our institutional mutual fund or buying a $100 million SMA. Compare that today, where you can go out and buy a single share of the ETF for whatever it's trading at, $32, wherever it is today. And so it's, it is much more widely available. And those different vehicles do have slightly different flavors, to your point. And so important to note that the flagship quality strategy is a global, it is a global strategy. Having said that, the primary users of that flagship strategy continue to benchmark that against the S&P 500. It's a great way of getting large cap US exposure. If, however, you want to have tighter reins around what your regional exposures looks like within your overall equity portfolio, as some allocators do, the ETF is available, and that is a US only version of quality. So whereas the global strategy has on average 22% of its weight invested in companies allocated outside of the US, the ETF has 0%. We've been running them side by side now for, I don't know, 15, 16 months. And their return patterns have been pretty close to each other from a factor exposure, from a sector exposure, all of those things. They look very similar to each other. And that's by design.
Wonderful. Thank you for that. I think we have come up on time, and we don't want to keep you guys too much longer. And we've answered all the questions in the chat. I just wanted to take a moment to thank you and Ben for helping us put this together for our clients. I wanted to thank our clients who were able to join us. Thank you so much for listening, and we look forward to meeting with each of you soon on your individual portfolios and financial plans. And we're going to continue to do some of these webinars on the portfolio as we continue to move through the year. If you have any feedback, we would love to hear it. I do think I neglected to introduce myself at the beginning of the video because I had muted myself, but I'm Ashley Nichols. For those who I haven't met yet, I'm joined by Luke Johnson here at the desk. And again, please feel free to get in touch with either of us. And we appreciate everyone's participation today.
Thank you, guys. Greatly appreciate the time and the continued partnership.
Thanks, everybody.
Take
Thanks
care.
for your questions.
Thanks, everyone.
Thanks, guys.
Take care.
Bye.